October 28, 1929 was meant to be just another Monday. Business professionals in Manhattan took the subway to their offices, scanning newspapers that proclaimed American wealth would endure indefinitely. Secretaries composed correspondence about unprecedented profits. Financial institution executives tallied deposits that appeared to increase miraculously. And nationwide, typical families organized vacations they could suddenly manage, purchased automobiles on credit they believed was secured, and observed their stock portfolios ascend toward the stratosphere. Nobody realized they were experiencing the concluding hours of the most significant economic fantasy in American history. Nobody comprehended that the very assurance propelling their wealth upward was the identical mechanism that would annihilate it by Tuesday afternoon. The collapse of 1929 was not coincidental. It was the unavoidable culmination of a decade-long trial in financial delusion, where an entire nation persuaded itself that wealth was everlasting, debt was benign, and markets could only ascend. Yet the genuine narrative is not merely what transpired when the bubble exploded. The genuine narrative is how assured, intelligent individuals convinced themselves that this occasion was unique, that the traditional principles of economics no longer functioned, and that the celebration would never conclude. Because the identical fantasy that annihilated fortunes in 1929 persists in every bubble subsequently. To comprehend the insanity, you must commence with the insanity that preceded it. The 1920s were not merely prosperous. They were intoxicating. America had emerged from World War I as a creditor to the globe, its manufacturing facilities intact, its financial institutions flush with European gold. For the first occasion in the nation's existence, typical workers could manage luxuries their ancestors had only imagined. Radios, automobiles, refrigerators, and washing machines emerged from assembly facilities and into residences across the nation. Henry Ford had mastered mass manufacturing, making vehicles affordable for the middle class. Thomas Edison's electrical network was illuminating metropolitan areas from coast to coast, and consumer credit made everything achievable, permitting families to acquire now and compensate later. But here is where the narrative becomes hazardous. When individuals feel wealthy, they behave wealthy. And when they behave wealthy, markets respond by making them feel even wealthier. The stock market became the national fixation. Barbers provided stock recommendations between haircuts. Taxi operators discussed their portfolios. Housewives combined funds to acquire shares in corporations they had never encountered. The market was not merely an investment. It was evidence that America had uncovered the formula to endless wealth. Between 1924 and 1929, the Dow Jones Industrial Average tripled. Stocks that cost $50 in the spring were valued at $150 by autumn, and everyone who purchased early appeared like a genius. The mechanism driving this wealth was credit. Not merely personal credit for vehicles and appliances, but financial credit that permitted investors to acquire stocks with borrowed funds. Brokers provided something called purchasing on margin, where you could acquire $100 worth of stock with only $10 of your own funds. The broker would advance you the other $90, employing the stock itself as collateral. If the stock increased, you retained all the profit. If it declined, well, nobody discussed that because stocks only ascended. By 1929, margin purchasing had become so prevalent that $6 billion in broker loans were outstanding. That is equivalent to over $90 billion currently. All of it wagering that the celebration would persist forever. The psychology was intoxicating and toxic simultaneously. Every success narrative reinforced the fantasy. Joseph Kennedy, father of the future president, accumulated millions speculating in stocks and real estate. Jesse Livermore became a folk legend for his capacity to predict the market perfectly. Typical individuals read about these titans and believed the identical principles applied to them. Financial publications published articles with titles like "Everybody Ought to Be Rich" and "The Permanent Plateau of Prosperity." Irving Fisher, one of the most respected economists in America, proclaimed in October 1929 that stock values had reached a permanently high plateau. Even the authorities believed their own propaganda. But beneath the surface, fractures were already appearing for those who cared to observe. Corporate profits were not expanding sufficiently to justify stock values that had tripled in 5 years. Unemployment was creeping higher as corporations automated manufacturing. Farm values had been declining since the early 20s, crushing rural economies that politicians preferred to disregard. European nations still recovering from the war were struggling to repay debts to American financial institutions. And the Federal Reserve, worried about speculation, had been elevating interest rates to cool the market. Higher interest rates made borrowing more expensive, but they also made the bubble more fragile. When the cost of credit increases, highly leveraged wagers become harder to maintain. The warning indicators were everywhere, but they were drowned out by the noise of celebration. Radio programs celebrated the stock market like a sporting competition. Newspapers printed daily narratives of typical individuals who had abandoned their employment to trade stocks full-time. Department stores reported record revenues as customers splurged on luxury merchandise, confident their portfolios would cover the expenses. The entire economy had become dependent not merely on consumption, but on the conviction that consumption could expand forever. And that conviction rested on one fragile assumption: that stock values would never decline sufficiently to threaten the system supporting them. Here's what made the situation so hazardous by October 1929. The stock market was not merely a venue where wealthy individuals gambled with spare funds. It had become the foundation of middle-class wealth. Teachers, clerks, and factory workers had invested their life savings into stocks, convinced they were investing in America's future. Financial institutions had advanced billions against stock portfolios, treating volatile securities as if they were solid assets. Corporations had employed their own stock as collateral for expansion loans, wagering their expansion on the market's continued ascent. The entire financial system had become a house of cards where each level supported the ones above it. And the cards were already starting to tremble. In September 1929, the market had begun displaying signs of strain. Some stocks declined sharply before recovering. Margin demands started to increase as nervous brokers demanded more collateral from leveraged investors. Smart money began quietly relocating to the sidelines, though few noticed because the overall trend was still upward. Roger Babson, a financial forecaster who had been warning of trouble for months, repeated his prediction that a collapse was approaching soon. But his warnings were dismissed as the pessimism of an individual who had missed the greatest bull market in history. By the final week of October, the market was operating on fumes and false assurance. Professional traders could sense something was incorrect, but they could not identify exactly what or when it might rupture. Individual investors remained convinced that any decline would be temporary, another purchasing opportunity in a market that rewarded faith with fortune. Brokers continued extending margin loans because the commissions were too profitable to refuse. And newspapers kept printing optimistic headlines because optimism sold papers better than warnings about systemic risk. The stage was arranged for catastrophe, but nobody wanted to accept it. On Sunday, October 27th, families across America attended church, reviewed the financial pages over breakfast, and organized their week around the assumption that wealth was permanent. Children played in suburban yards made achievable by stock market gains. Parents discussed college funds that appeared to expand by themselves. And somewhere in the back of everyone's mind was the quiet assurance that they had uncovered something previous generations had missed. A method to get wealthy without risk, to construct wealth without work, and to trust that markets would always reward faith with fortune. By Monday morning, that faith would be tested in ways nobody could imagine. Monday morning, October 28th, arrived with an unsettling quiet on Wall Street. The usual commotion of traders and clerks felt different, charged with an electricity that veterans of the market recognized but could not quite identify. It was the kind of tension that accumulates before a thunderstorm, when the atmosphere grows thick and animals sense danger that humans disregard. But most investors dismissed the feeling, attributing it to normal Monday morning jitters after a weekend of reading financial pages that still promised endless wealth. The opening bell rang at 10 o'clock, and within minutes, the character of the market revealed itself. Values did not surge upward as they had for months. Instead, they wavered uncertain like a drunk individual trying to find his balance. General Electric, which had been a darling of speculators, opened lower. Radio Corporation of America, the stock that had created more millionaires than any other, stumbled in early trading. United States Steel, the backbone of American industry, displayed weakness that sent whispers through the trading floor. But this was not panic. Not yet. Experienced traders had witnessed volatile openings before. The market was simply catching its breath after the spectacular gains of recent weeks. Smart money would step in, bargain hunters would emerge, and by afternoon the familiar climb would resume. That was the script everyone expected. The pattern that had repeated itself dozens of times over the past 5 years. Temporary weakness followed by renewed strength. Doubt conquered by assurance. Fear overwhelmed by greed. The challenge was that the smart money was not stepping in. It was stepping out. While typical investors perceived declines as purchasing opportunities, professional traders were quietly liquidating positions they had maintained for years. They could interpret the subtle indicators that amateurs missed. The way volume spiked on down movements, the reluctance of purchasers to support declining values, the growing desperation in margin demands that brokers were making with increasing frequency. The professionals comprehended something that the public did not. In a leveraged market, assurance is not merely helpful. It is essential. And assurance was fracturing. By noon, the weakness was impossible to disregard. Stocks that had opened down a few points were now down 10, 15, 20%. The ticker tape, which had chronicled so many triumphant ascents, began to lag behind the flood of sell orders. Traders who had spent months celebrating paper profits observed them evaporate in real time. Margin demands, once rare enough to be noteworthy, became a constant drumbeat. Brokers demanded immediate payment from investors whose collateral was shrinking by the hour. And those investors, many of whom had borrowed against everything they owned, confronted a terrible choice. Find cash immediately, or observe their positions get liquidated at whatever value the market would bear. The psychology of the crowd began to shift in ways that would have been impossible to predict just hours earlier. Investors who had been supremely confident at breakfast found themselves questioning everything by lunch. If General Electric could decline 20% in a morning, what other assumptions were incorrect? If margin demands were wiping out neighbors and friends, how secure were their own leverage positions? The market was not merely a financial mechanism. It was a reflection of collective conviction, and that conviction was fracturing in real time. What made Monday's decline so devastating was not merely the magnitude of the losses, but their velocity. In previous market corrections, values had declined gradually, giving investors time to adjust their thinking, raise capital, or find purchasers for their holdings. But the combination of massive leverage and interconnected positions created a different dynamic. When one highly leveraged investor was forced to sell, it pushed values lower, triggering margin demands for other leveraged investors, who were then forced to sell, pushing values even lower. It was a cascade, each sale creating the conditions for more sales, each margin demand generating new margin demands. The human drama playing out on trading floors across the country was brutal and immediate. Individuals who had considered themselves financial geniuses just days earlier observed their fortunes disappear in hours. Secretaries fielded frantic phone calls from investors begging for more time to meet margin requirements. Financial institution officers who had enthusiastically approved stock-backed loans in the morning were calculating potential losses by afternoon. And in offices, residences, and clubs across America, individuals were beginning to comprehend that the wealth they had counted on was not wealth at all, but borrowed assurance backed by borrowed funds. The afternoon brought no relief. If anything, the selling intensified as the reality of the situation sank in. This was not a temporary correction or a healthy pullback. This was a fundamental breakdown in the system that had created so much paper wealth. Stock values were not merely declining. They were collapsing toward levels that made margin loans impossible to maintain. Brokers who had been happy to advance 90 cents on every dollar of stock value were suddenly demanding immediate repayment. Financial institutions that had treated stock portfolios as solid collateral were recognizing them as toxic assets that could not be valued with any assurance. The most telling indicator of the crisis was not in the numbers on the ticker tape, but in the behavior of the individuals who comprehended markets best. Floor traders who had constructed their careers on quick reflexes and perfect timing were paralyzed by the velocity of the decline. Brokers who had spent years encouraging clients to purchase on margin were now desperately trying to reach those same clients to demand more collateral. Financial institution presidents who had celebrated the democratization of stock ownership were calculating how many depositors they might lose when margin demands could not be met. As the closing bell approached, the extent of the damage was becoming clear. The Dow Jones Industrial Average had lost over 12% of its value in a single day. Individual stocks had declined 20, 30, even 40%. Billions of dollars in paper wealth had simply vanished, not transferred to someone else, but destroyed by the recognition that it had never really existed in the first place. And yet, even as Monday's trading session concluded, most investors still believed this was an aberration, a violent but temporary correction that would be followed by recovery. The newspapers that evening attempted to strike a balance between acknowledging the day's losses and maintaining the assurance that had fueled the boom. Headlines spoke of a sharp break in heavy selling, but editorials insisted that the fundamental strength of American business remained intact. Financial authorities quoted in evening editions suggested that the market had simply been due for a healthy correction after such spectacular gains. Political leaders issued statements about the soundness of the banking system and the resilience of the American economy. But in brokerage establishments across the country, a different conversation was occurring. Margin clerks were working through the night, calculating how many clients would receive demands in the morning, demanding immediate payment. Traders were reviewing their own positions, wondering which stocks would open lower and how far the decline might continue. And financial institution officers were quietly reassessing loan portfolios that had appeared solid on Friday, but appeared dangerously exposed by Monday night. The genuine tragedy was not merely financial, but psychological. Millions of Americans went to bed on Monday night with their first genuine taste of doubt about the system that had made them feel wealthy and secure. The market was not merely an investment vehicle. It had become the foundation of their optimism about the future, their assurance in American capitalism, and their conviction that wealth was their birthright. When that foundation fractured on Monday, it did not merely threaten their funds, it threatened their entire comprehension of how the world functioned. Tuesday morning would bring answers to questions that nobody had wanted to ask. How far could values decline? How many margin demands could the system absorb? How much borrowed assurance could evaporate before the entire structure collapsed? But as Monday night settled over a shaken nation, those answers still lay hidden in the darkness, waiting for the opening bell to reveal the genuine cost of believing that wealth could be constructed on nothing more than faith and borrowed funds. Tuesday morning arrived like a funeral procession. The sun rose over Manhattan just as it had every day for centuries, but the metropolis that awakened beneath it was fundamentally different from the one that had gone to sleep. Across America, investors who had tossed and turned through the night reached for their morning papers with trembling hands, hoping to find reassurance that Monday's collapse had been a nightmare from which they could still wake up. Instead, they found headlines that confirmed their worst fears and hinted at terrors they had not yet imagined. The pre-market indicators were catastrophic. Overnight, European markets had plummeted in sympathy with New York's decline, creating a global wave of selling that was now racing back across the Atlantic like a financial tsunami. London had closed down sharply. Paris had suffered its worst day in decades. And in the early hours of Tuesday morning, as American brokers tallied the overnight orders that had poured in from panicked investors, it became clear that Monday's 12% decline was not the conclusion of the crisis. It was merely the opening act. The human cost of Monday's collapse was already becoming visible in ways that stock charts could not capture. Across the country, families sat around breakfast tables in stunned silence, confronting the reality that their children's college funds had evaporated overnight. Middle-aged workers calculated how many years they would need to rebuild retirement savings that had taken decades to accumulate. Small business proprietors who had employed stock portfolios as collateral for expansion loans confronted the prospect of bankruptcy before the week was over. The American dream had not merely been delayed. For millions of families, it had been obliterated. But the most dangerous element was not the losses that had already occurred. It was the web of interconnected obligations that those losses had set in motion. Financial institutions that had advanced billions against stock portfolios were now holding collateral worth a fraction of the outstanding debt. Insurance corporations that had invested policyholder premiums in the market confronted potential insolvency. Corporations that had employed their own stock to secure credit lines were discovering that their access to capital had vanished, along with their share values. The entire financial system was discovering that wealth constructed on borrowed assurance could collapse faster than anyone had thought achievable. The psychology of Tuesday morning was unlike anything America had experienced. For the first occasion in a generation, the fundamental assumption that markets rewarded optimism with profits had been shattered. Investors who had spent years believing that every decline was a purchasing opportunity were now terrified that every rally was a trap. The mental framework that had guided financial decisions for nearly a decade had become not merely useless, but hazardous. Assurance, which had been the mechanism of wealth, was now the enemy of survival. When the opening bell rang at 10 o'clock on Tuesday, October 29th, the selling commenced immediately and intensely. There was no period of hesitation, no moment of doubt, no pause for reflection. Orders to sell poured onto the trading floor like water through a broken dam. General Motors, which had symbolized American industrial might, opened down 20 points. Westinghouse Electric, the corporation that had electrified the nation, declined 30 points in the first hour. Radio Corporation of America, the stock that had created more fortunes than any other, collapsed so rapidly that traders could not keep up with the value changes. The ticker tape, which had been the scorecard of American wealth, became an instrument of torture. It fell further and further behind the actual trading, creating a surreal situation where investors could not even know how much funds they were losing in real time. The delay between trades and their appearance on the tape meant that by the time investors observed a value, it was already obsolete, replaced by something even worse. It was like trying to navigate a sinking vessel with a compass that displayed yesterday's position. The volume of selling was unlike anything the New York Stock Exchange had ever handled. Trading that normally processed 3 million shares in a busy day was attempting to process 16 million shares. Overwhelming systems that had been designed for a gentler, more civilized market. Floor traders, accustomed to the choreographed dance of professional purchasing and selling, found themselves caught in a stampede. Orders arrived faster than they could be executed. Values declined faster than they could be recorded. And the machinery of American finance, which had appeared so sophisticated and modern just days earlier, revealed itself to be fragile and inadequate when tested by genuine panic. The human drama on the trading floor was both heroic and heartbreaking. Clerks worked with desperate efficiency, trying to process sell orders that represented the life savings of individuals they would never meet. Traders who had constructed their reputations on cool professionalism found themselves shouting to be heard above the chaos. Phone operators fielded calls from investors who pleaded, threatened, and begged for information about positions that were dissolving by the minute. And, in the galleries above the trading floor, spectators who had arrived to witness the excitement of American capitalism instead observed the destruction of everything they had believed about funds, markets, and the future. The cascade of margin demands that had commenced on Monday became an avalanche on Tuesday. Investors who had borrowed heavily to acquire stocks were receiving demands for immediate payment that they could not possibly meet. Many had already exhausted their savings attempting to meet Monday's demands. Others had borrowed against residences, businesses, and life insurance policies to maintain their positions. By Tuesday afternoon, brokers were liquidating accounts without waiting for permission, selling stocks at whatever value they could obtain to recover loans that had become hopelessly underwater. The psychological impact of these forced sales was devastating and self-perpetuating. Each liquidation pushed values lower, which triggered more margin demands, which forced more liquidations, which pushed values even lower. It was a death spiral that fed on itself, growing more destructive with each turn. Investors who might have maintained their positions through a normal correction were forced to sell at the worst possible moment, not by choice, but by the mathematical reality of borrowed funds in a declining market. Financial institutions across the country were confronting a crisis that their executives had never imagined achievable. Loans that had appeared conservative when backed by blue-chip stocks were now secured by assets worth half their original value. Depositors who had entrusted their savings to institutions they believed were rock solid were beginning to question whether their funds were secure. And financial institution officers who had spent years approving stock-backed loans with assurance were now calculating potential losses that could wipe out capital accumulated over decades. The ripple effects extended far beyond Wall Street. Small communities across America were discovering that their local financial institutions had invested heavily in the stock market, either directly or through loans to investors. Main Street businesses that had counted on credit from those financial institutions were finding that funds were suddenly unavailable. Farmers who had borrowed against expected crop revenues were confronting demands for immediate repayment. The financial crisis was metastasizing from a stock market challenge into a banking challenge, from a banking challenge into a credit challenge, and from a credit challenge into an economic catastrophe that would touch every corner of American life. By midday Tuesday, something unprecedented was occurring. The most powerful financiers in America were meeting in emergency session, not to profit from the crisis, but to prevent the complete collapse of the financial system. J.P. Morgan Jr., Thomas Lamont, and other banking titans gathered to coordinate a response that they hoped might stabilize the market before it destroyed everything they had spent their lives constructing. But even their vast resources appeared insignificant compared to the magnitude of the selling pressure that was overwhelming every attempt to establish a floor under values. The irony was cruel and complete. The identical leverage that had multiplied gains on the way up was now multiplying losses on the way down. The identical assurance that had driven values to unsustainable heights was now creating panic that drove them to equally unsustainable lows. And the identical democratization of stock ownership that had made millions of Americans feel wealthy was now making those same millions feel betrayed by a system they had trusted with their futures. As Tuesday afternoon wore on, the scope of the disaster became impossible to deny. This was not a correction, not a healthy pullback, not a temporary setback in an otherwise sound market. This was the collapse of a financial structure that had been constructed on borrowed funds, borrowed time, and borrowed assurance. The celebration that had appeared like it would last forever was concluding not with a gentle fade, but with a crash that would echo through generations. The 29th of October 1929 was not merely a date on a calendar. It was the moment when an entire nation discovered that wealth constructed on borrowed assurance is not wealth at all. It is a beautiful, dangerous fantasy that can evaporate faster than the paper it was printed on. The families who went to bed wealthy on Sunday and woke up ruined by Wednesday learned what every generation must learn again: that markets do not reward faith with fortune forever, and that the higher the bubble ascends, the more devastating its collapse. But here is the lesson that matters most. The collapse of 1929 was not a historical accident or a unique failure of an innocent time. It was the inevitable result of believing that this occasion was unique, that old principles no longer functioned, and that wealth could be constructed on nothing more than optimism and leverage. Those identical fantasies persist in every bubble subsequently, wearing new clothes but conveying the identical lies. And when the next crash arrives, it will destroy those who trust the system most and reward those who comprehend that assurance without substance is not wealth. It is simply assurance waiting to be shattered. History doesn't repeat, but if you disregard its warnings, it will crush you all the same. If this gave you a new perspective, hit subscribe. History has the answers.